Hello, welcome again. So in this video, we will discuss about the statement of cash flows, and we will see what are the three different types of activities that affect the company's cash flow. Okay, so let's move on. So statement of cash flows required for each period when balance sheet and income statements are presented. So after presenting the balance sheet and income statement, we need to prepare the cash flow statement. Okay, then the cash flow statement provides information about the cash receipts and cash disbursements. Okay, how much amount of cash we are receiving, meaning how much cash is coming and how much cash is going out from our business. Okay, and this cash is coming and going from three different sources, so we'll discuss about that. So, and this cash flow statement is helpful for assessing the future profitability, assessing the liquidity and long-term solvency. So if you have more money, it has both the positive and negative side. Okay, so there are three types of activities that affect the company's cash flow, and the first one is the operating activities, second one investing, and third one is the financing activities. And one trick over here, see that the operating activities usually affect current assets or current liabilities. See that? And investing activities affects the long-term assets, meaning either long-term assets will increase or decrease. And the financing activities affects the company's long-term liabilities or the owner's equity. So this one, please remember this, that operating activities affect the current assets or current liabilities, and investing activities affect the company's long-term assets, and financing activities will affect the long-term liabilities and owner's equity. So what are the operating activities? And you know that this is the inflows and outflows of cash that result from activities reported in the income statement. Okay, and the cash inflows from operating activities are the sale of goods or services and interest and dividends from investments. These are the inflows. And for cash outflows from operating activities, purchase of inventory, or you are required to pay the salaries, wages and other operating expenses, and interest on debt, income taxes. See that these are the operating activities. Okay, then investing activities. So inflows and outflows of cash related to the acquisition and disposition of long-lived assets used in the operation of the business and investment in assets. Okay, so the cash outflows are purchase of long-lived assets used in the business, and the purchase of investment securities like stocks and bonds of other companies, and loans to other companies, entities. The sale of long-lived assets used in the business, we can have money by selling the long-lived assets, or we can have money by selling the investments. We can also have money from the collection of a non-trade receivable. Okay, these are the investing activities. And the financing activities, inflows and outflows of cash related to external financing of the company with owners or creditors. See that? So from owners when shares are sold to them, and from the creditors when cash is borrowed from notes, loans, mortgage and bonds, and cash outflows to the owners as dividend or distribution to the owners, and to the creditors when we are repaying the loans. Okay, and there are two methods to prepare the cash flow statement: direct method and indirect method. In the direct method, what we will do, we will sum up, we will sum all the cash receipt and then subtract all the cash payment. This is actually direct method. Okay, and in indirect method we will start with net income and then we will make some adjustment, either add or subtract some expenses and revenues. Okay, and here is an example of the direct method. See that from the operating activities, so what we have done over here, that we received from customers, we pay to suppliers, pay to employees, and interest payment, income tax expense. So we have the receipt and we have the payment. So this is the total amount from operating activities. And investing activities, see that renovation and improvements, meaning it's an investment, cash outflow. And financing activities, issuance of common stock, issuance of long-term liability and dividend paid, see that. And finally we have the net increase or decrease in cash flow, this amount. This is how we prepare the direct method. And in case of indirect method, that we can see that we started with the net income. So this is the net income we started with, and then we have add back depreciation, then we have subtracted gain on sale of equipment, we have add back loss on sale of long-term investments. So this is how, just check on this. And cash flows from investing activities, see that purchase of equipment, it's going out, so that is why it's negative. Then proceeds from the sale of equipment, it's positive one because we are getting money by selling. So this is how. And cash flow from financing activities, you can see that proceeds from note payable, repurchase of common stock, and payment of cash dividend. See that, and net cash. So finally cash at the end of the year. So this amount of cash we have. Okay. So here are the different transactions, and we need to find out which one is either operating, financing, or investing activities. Okay. So now the first one, see, issuance of common stock. I think you can sense that this is financing activity and borrowing long term. So what is this? This one is also financing. Sales revenue, this one is operating. Then payment of dividends, okay, this one is financing. Then purchase of land with cash, investing. Then purchase of treasury stock, so this one is financing. Paying bonds payable, financing activities. Interest expense, so this one is operating. Sale of equipment, investing. Cost of goods sold, operating. Purchase of another company with cash, so investing. So this is how you classify the transactions, which are whether the transaction is operating, financing, or investing. Okay.